at the, I think if I remember right, we finished at, the decision rule, right? We're recording this session. Dismiss, okay. Right. And see that stop recording is an option. So here. So we finished here, and I told you the decision rule. It's very important to understand. I'm going to quickly wrap it up once again. So you're using what is called the price versus fair value paradigm. Very important to understand that. Okay, this is an important way to, you may not be aware of it, but most of the time when you're doing fundamental analysis, this is the kind of paradigm that you're using, right? And in the case of most of the common fair value models, I give you the exception in the case of AFV. Okay, we can call this AFV. Barring the AFV exception, in general, most of these are subjective models, and these are, you're applying this price versus fair value paradigm. It's a very precise paradigm. And what it is basically it involves a comparison between, first you take note of the price, and it's all flowing from here, by the way. Okay? Underlying value that does not depend on the share price. So here straight away he's making a distinction between these two concepts. And here you can see, you look at Apple, you see it here, you can see the price quite easily, no problem. Take note of the price. And then ask yourself, what is my assessment of fair value for Apple common stock? You do your analysis, you do your fundamental analysis. This involves doing industry analysis, global economy analysis of the global economy, the major markets for Apple. Then what is the demand like? You do that macro level forecasting. And then you do the product level forecasting, unit level forecasting, and all that. And then you come out with projected earnings, where you project the costs and all that. So when you do this exercise in your project, also please start getting used to the idea of doing spreadsheets, where you start projecting these kinds of estimates and do the entire balance sheet. Okay, do the entire financials like operating expenses, depreciation, all these kinds of things, tax expense. So get used to doing that on a spreadsheet, because that's something else that people expect from MBA grads. That the ability, they have, not only do they have conceptual clarity, but they have the ability to quickly get the job done by using spreadsheets and stuff, so that they can quickly enter the formula. They're very comfortable using spreadsheets. So that is an expectation that people have from you, so make sure you don't disappoint them. So do all that, and then so what you do is you do all this analysis, you come up with a fair value estimate using a model like this, and using this kind of a basic structure of this model, this type of model, and you then compare the price to the fair value, and if then you apply this decision rule. In this paradigm, the decision rule is, if the price is less than fair value, you buy, and if the price is greater than fair value, either you sell or you don't buy. This don't buy is important because a lot of the traditional investing, if you see the way that MBA courses are structured in most business schools, they talk about implicitly, actually, they talk about the traditional investing, traditional asset management, which is basically long only positions that they don't go short, and they are confined to stocks and bonds. That's a traditional asset management paradigm. That's why you'll hear of distributing. Even here, you can see that actually. In this book also, you'll see stocks and bonds. He's only talking about putting money into stocks and bonds and cash. Okay. So cash is, of course, the default. Initially, when you start, you just have the cash, and then you distribute some of that cash. Some of it goes into bonds, some of it goes into stocks. So the reason I said this is that if you're a long-only investor, like most of the traditional mutual funds are, you don't have the luxury of being able to sell if this is the case. So in that case, what you do is you don't buy. Okay? So understand this decision rule. So it's a simple framework, but understand that you're always using this framework when you are using fundamental analysis, and this will become important in many other areas. Wherever you're using price versus fair value comparisons, this is the implicit paradigm, and this is the implicit decision room. Right? So these are important points. I thought I'll just repeat it. So we've lost a fair bit of time today without covering new ground. But this is important stuff. So yeah, and as usual, I've added. So please go through the notes again and again, because later on I look at the notes and I add some parts, some text where I feel it's not very clear. So I try to put myself in the student's shoes and try to make it a little bit clearer. But again, as I said, it's your responsibility. If there's anything in the notes you don't understand, you have to tell me, and then I'll make it clearer. So, all right. So this is the thing. So let's go into now. I think this completes our discussion of fair value models. It's important to understand because most of your jobs are on involve these kind of valuation exercises. You have to understand this basic, all this stuff that we discussed over the last few sessions. Be clear about the fundamentals. Okay, so let's look at this next statement. The market is a pendulum. This we have already covered actually, right? So the market is overvalued. Market rationality we covered. Market efficiency we covered. All this stuff. So weak form efficiency, semi-strong, etc. Just understand these definitions. Make sure you understand the definitions. But don't worry if it's not very clear. If you go to, like somebody was asking that question, it's not a very precise definition. She's right, actually. This whole framework is not very precise. But people in the market, in the industry, they don't go into so much depth. So this is something that they like to talk about. So you should just understand it at a moderate level of depth and understand broadly what the idea is, and be conversant with these different nuances, weak form, semi-strong, what it means, etc. So this I've already given you a brief introduction, right? Now, I think this we have not discussed. I don't think we had time to discuss, right? We had not, I think we didn't discuss it. This is an important point, actually. We're going to have a little bit of a discussion on it. Where is this point coming from? This, again, what I'm doing is, as I'm going through, just try to understand what I'm doing. As I'm going through each of the sections, so section heading is given like the chapter heading. The chapter heading is given here, right? Note about Ben Graham. This is the chapter. So under that, there are various points in the text that I wanted to make, write some commentary on or have a discussion on. And then we have these discussions by highlighting these points. All right. So similarly, one of the points that is made, which require us to have a broader discussion because it relates to the fundamentals of finance. So we want to make sure that everybody's clear about those things. So market is a pendulum. Future value. Yeah, we already started this discussion. Okay, the future value of every investment function of the present price. It's actually, yeah, well, he's assuming that you enter at the present price, which is reasonable, but should have been made a little clearer. So the higher the entry price, the lower the return, obviously. All right. And this, of course, we had a brief look at. Now, let's look at this. That this take up this on this statement. Entry price versus returns. Okay, so what is he saying here? Entry price versus returns. Future value is a function of its higher the price you pay, lower the return. The entry price versus return. And let me make sure that I have page 13. All this relates to page 13. So, yeah. Okay, that's fine. So if we have this page 13 here, then all the other points are on page 13, all related to page 13. So this is still on an unread page 13 every time. Okay, so entry price versus returns, and the particular statement is okay. So here we're going to talk about some basic aspects of return analysis and understand why the statement is true. A statement is obviously true because we are human beings, we are not computers. We're smarter in that sense than computers. We may be slower than them at calculations, but we are smarter than them. So this is obviously apparent to everybody. Everybody understands what this is. The higher the price you pay to get into the investment, the lower the return. Ceteris paribus, of course, right? So that is the final value of the investment should be the same in all cases. In that case, the higher the price you pay to enter, the lower the return is going to be. So this is very obvious intuitively to everybody, but we should still make sure we get a good understanding from a let's look at it this way. So we just do a calculation here. So we make sure that we understand. What are we saying here? So if we look at the return, okay, um, here. Okay. So let's say this is an investment which doesn't pay. So what we're trying to do is just take a very simple statement like this. The higher the price you pay, the lower the return. Of course, please understand this for yourself. When you actually make these kind of statements in a business context, you have to add ceteris paribus, other things remaining the same. Okay, that is how you cover yourself. Then that statement is always correct. So this guy is not that careful. But you should always be that careful when you make a statement like this in a business context. The statements you make have to be correct all the time. If they're not always correct, then you should qualify it by saying generally or something like that, which means it's generally true, but sometimes it may not be true. So be very careful about the way you write. This is written communication guidelines, and it also affects the way you think. So it's very important to be very particular about how you communicate here and how you think this way. Okay, so we look at what was I saying? So the entry price. Suppose I buy some. So suppose there's no coupon somewhere in a particular investment, right? There's no coupon here, and so we exit, and the exit price is let's say 100. Okay, so we are buying a treasury bill. So how should I write the return on the? So if I look at the return figure, very basic stuff. Okay, but I'm doing it because sometimes we find that even basic stuff people don't are not clear about. Okay, so if we take return and we put this all together. So numerator, denominator, we'll put numerator, denominator here. Okay. So the numerator is in the return is what? Numerator is what? What should we write? So this is an investment where you enter at 80 and you get out at 100. Okay. So what we are trying to do is calculate the return. The return will obviously be a percentage figure. Okay, so it'll be a ratio, and it'll be so then we have a numerator and a denominator. So what should we put in the numerator here, folks? Tell me the formula.
So entry price minus exit price. Exit
20 divided by 80 into 100.
Yes,
No,
sir.
don't do 20 first. How did you get the 20? So when you're writing formula, you have to, so 100 minus
entry.
So exit minus entry. So you notice that the person who spoke first actually said entry minus exit. Who was that? I don't know whether it was. I couldn't see. I was not looking at the faces. But anyway, the person doesn't matter. But we're all together here in this discussion. So, so somebody, I thought I heard you say entry minus. So let's be clear. First is it's exit minus entry. Okay. So let's be clear about that. So numerator should be exit minus entry. All right. So entry. Okay. So exit price minus entry price. Exit price minus entry price. And this will be useful for you later on when you calculate returns also. Because it's always when you calculate your loss. I mean, I may not have time to discuss that with you guys in this course. But later on when you get down to calculating returns in any calculating your P&L on a particular trade, okay, you will find that the general formula for P&L is exit minus entry. And if you so that will always work out. So that will get your basics right. And if you make this taking up too much space. Okay, so numerator exit minus entry price. Where do we write this actually? So I'll just make this a little bit smaller. Okay. 18 will make it 14. Okay, so we have this. So now we have here we can write exit minus entry price. Okay. So exit minus entry. All right. 20. Okay, that's how we get our 20. And what is the denominator?
Entry price.
Entry price, correct. So the denominator is entry price only. So again, as I said, very, very obvious stuff. You might be wondering why I'm doing this, but I want to make sure that everyone's, because this is how you would teach a computer. So I want you to treat your brain like a computer and always talk to your brain like it's a computer and you're also a computer. So always communicate like that. That'll clear up your thinking. It'll make your thinking much more rigorous and you won't make any errors. Okay, so make sure your fundamentals are very clear. So entry price. So as somebody said, denominator is entry price. Okay, is that clear? So denominator should be entry price. All right, and then we can say our return is. We just write it here. Easier to see in the center. So our return is numerator by denominator. Right. So here's our return. Okay. Now what is this guy saying? The higher the price you pay to enter, the lower the return. Okay? Ceteris paribus, remember, has to be put that way. So yeah. All right. So this is 25% is the return. Okay. Now, what is the statement he's making? How higher the price you pay, the lower the return. So let's do that. We want to check that the entry price is raised. So I'm going to raise the entry price to 90 and notice what happens to cell G17, which is our return. Okay, so I'm raising the entry price. Okay, return goes down. Everybody is happy. Okay, of course, people are not happy when the return goes down. But now you see this. Okay, so now I'm going to, and so obviously the opposite of this is the lower the price you pay, the higher the return. The lower the entry price, the higher the return. Okay. So again, as I apologize for doing such basic stuff with you, but I want to make sure that sometimes we find some of the students are not clear about the basics also. We want to make sure that and this will help you in the later calculations as well. So this is your basic treasury bill calculation. It's a basic zero coupon bond calculation. All right. And if it's a one period return, then you can just add a coupon to this, okay, which will go into your into the numerator. If you have a coupon, there will be a coupon in that, and that's the total realization. Okay, so it's actually the same. Yeah, so it's the return that you get, the gross return, and this is the percentage return that you get, the ratio. Okay, so if you take 90 and if we reduce it further, we buy at 70, and then the return should go up. See, the return is much higher now. Okay, so this is your basic zero coupon bond calculation, or a treasury bill calculation, any zero coupon structure where there is no return as such. There is no investment return in terms of income, but there is only a periodic income is not there, but you only have a price appreciation. Right. So this also shows you the two basic elements of return, which I will also write right here. He has not talked about it. Again, these are very general principles. One of the benefits of doing such very basic analysis is it allows us to focus on the absolute fundamentals, and those are very general fundamentals. They apply to all situations. So this is telling you something else. Because in this example, we did not explicitly look at any coupon return, right? We just said it's a zero coupon structure, treasury bill structure. But if you have a coupon, we discuss that possibility. So that tells us the basic structure of all asset returns. Okay? This is where you're getting into general principles. All asset returns, which means if I sell maybe some 100,000 Indian rupees and buy US dollars, hold the US dollars for 1 year, and then at the end of 1 year, I've got some investment income on my US dollars. I had to, let's say I borrowed the Indian rupees, 100,000 Indian rupees I borrow, and then I invest in US dollars. And at the end of the year, I sell back after 1 year. I find out whatever the dollar rupee rate is, and then I get, let's say I do this, take this example, and the rates are better. So let's say in 2016 I did this, whatever, let's say sometime here, and I hold it for 1 year, or maybe hold it for longer than that, somewhere here, and then I sell it. So what I have is from here to here, my entire holding period, I enter here, I exit here. What I have is two components. I'm paying interest on my dollar rupee, on my rupee borrowings. So I borrowed the rupee, then I sold the rupee, and I bought the dollars. So I have to pay interest on my rupee borrowings. Then I have a return on my dollar investment. So I have a net interest income, you can say, or net investment income. Okay? And so that's a periodic income, comes maybe every month or every quarter. And then at the end of the holding period, I have a price appreciation factor or depreciation. In this case, it is appreciated because I bought dollars when it was around, say, 67. And when I sold dollars, it was around 76. So I have 67 to 76. So if you do a calculation here, just take this example. Okay. So what we are trying to show you is that all asset returns, spelling mistake, have two components. Interest in comma here, because it may not always be interest, but it's in the nature of interest. It's a periodic net interest income. This is what the example I gave you. Suppose over the period my INR, okay, my INR interest is, I have to pay, I lose money, I have to pay interest of 80 rupees. Okay. Then in the US dollars, I make a return of maybe $45. So this obviously you can't compare this with this because this is rupees and this is dollars. You have to convert it to one currency. We're not going to do that right now. But what I'm trying to show you is this, and then there is the, we'll call it the del P. Del is for delta, del is the change. Okay, change. Del is the del price. Okay, so this is the every interest income, every investment return has two, all asset returns. Remember, I'm not saying stock returns. Notice this. So this is how you should talk when you're talking about general principles. Asset is very general. That's why I can talk to you about dollar rupee. I can talk to you about dollar rupee. This is not a stock. These are currencies. Okay? I could talk to you about crude oil. I could talk to you about soybeans or jeera. So all kinds of stuff. So that's why I've used the word asset. This can be applied anywhere. Could be commodities, currencies, equities, bonds, real estate. Okay, all asset returns have two components. Periodic net interest income, okay, which is equal to cost of borrowing the asset that's sold. Okay, these are very fundamental concepts. If you can keep these in your mind, you can analyze lots of complicated situations. Every asset return situation will have these elements. Okay, come to that. Cost of borrowing the asset that's sold. What is this in this example? I borrowed Indian rupees, then I sold it in the foreign exchange on the foreign exchange markets, and I got whatever $67. I had to pay 67 rupees per dollar. So I bought some dollars, whatever I could buy with 100,000 rupees. I bought those dollars, and then I put them on deposit. So this element here, periodic net interest income, consists of cost of borrowing the asset that's sold. Okay. So again, if you apply it in a different context, if you buy, let's say, a mall like PVR Socket, you assume, even if you had the cash, you assume that you would borrow the cash. And then you would take the cost of borrowing that amount of cash. So you're selling rupees and you're buying the mall. It's the real estate investment. Okay? Then you have to look at the rental returns on the mall. Every year, how much rental return do you make, etc. So periodic net is the cost of borrowing the assets that is sold, adjusted by return, let's say investment. So I borrowed Indian rupees, sold Indian rupees, and I'm paying 80 of interest servicing cost on that. Now I borrowed Indian rupees, sold the Indian rupees, and bought US dollars. I put the US dollars on deposit, and on that I earn 45 US dollars. So you have to convert them to the same currency. You can't compare apples and oranges. But once you do that, you take the net of these two, and that's your first component, periodic net interest income. Okay? You can also call this in general terms. I'll tell you what it is. So it's the cost of borrowing the assets that's sold, adjusted by, okay? I didn't say plus or minus. I just said adjusted by returns from investing the asset that's bought. It's pretty clear now. You can call this a net yield. Okay? The net yield. Okay? Net because this has to be adjusted by this. So it's not a gross yield. The gross yield here would be just $45. But that's not the whole picture. You've got to take into account the cost of earning this money. And that's the interest service cost of it. So that's a net yield. And then you have price. Okay. Now let's not call it appreciation, depreciation. Let's call it price variation. You notice how we use the words, the language. I was going to write appreciation, stroke depreciation. Instead of writing that, okay, you can still keep it for your convenience to understand. But price variation takes care of both. If I write price variation, it takes care of the, it is falling, it's price variation. It is rising, it's price variation. So any investment that you make will have two components. And you should be able to recognize these two components in any kind of investment, whether you're investing in real estate, currencies, commodities, equities, debt, same structure. Okay? This is what we call studying according to general principles. So as far as possible, you always look at general principles so that you can apply it in many, many different contexts, and it's easier for you to understand and retain the concepts. Okay. So you have two components, net interest income and price variation. Right? So here what we are looking at, the example that is there in the, what he's talking about, higher the price, you pay lower the return. Should be separate variables added here. So example we took in the first one, the treasury bill. There is no net yield concept here in the treasury bill because it does not pay any coupon. Okay? Of course, you have, in this case, there will be a net yield in the sense that you have to look at the funding cost of that. Okay? So you will compare what you do. What we in fact do is we compare the return here to the funding cost of paying this money to buy the treasury bill. So with whatever the funding cost on that is, we compare that to this return, and then we say that, okay, then what is the net return? So this is actually the gross return, and then you compare this to the funding cost of that, and then you get the net return. But it doesn't fit because there is no net yield component in this calculation because it's only got the price variation element, entry price to exit price. Okay. Is everyone following so far? I gave a long lecture on this, but everyone clear what because this we are talking about theory now. So it's very important to understand the theory, that because we have explained something very basic and very fundamental. So make sure everybody understands that all asset returns will have two components. Okay. Everyone clear about this, what we discussed? Yeah. Okay. Let's ask. Yeah. Okay. Good. Okay. So we have understood this bit. So the reason I wanted to go into this, although this is a very simple kind of statement, and it may be obvious to people, but it's still better to be able to show it mathematically that yes, indeed, when you change the entry price, it changes the return. Right? And then it also tells us the way to understand all asset returns, two components, and that also tells you how to analyze investments. You have to look at the cost of funding, and either you do it later, like here, we calculate this return, that's the gross return, but then we also have to factor in what is the interest cost on the $70 we had to pay to get into this interest. So this is not the whole picture. You have to you have to look at the interest cost on this as well. And then you adjust those two, and then you have the real net return. Okay. Now, yeah, what is it? The higher you pay, the lower the return will be. Yeah, okay. And this is fine. This gives you the basic idea. Now, one more thing here is I wanted to illustrate one more point because I want to make sure that sometimes I've seen that when I ask people this basic concern, basic question about the bond price, the relationship between bond prices and interest rates, and I don't get the right answer even in the second year. So I wanted to make sure that the very fundamental concept is clear to everyone, and we'll explain it again. So who should we ask? Let me ask. Okay, let's ask Ankit Jain 1. What is the difference? What is the relationship between bond prices and interest rates? The YTM here is what you guys did in the first year. YTM, the yield to maturity. So this is what we're taking as a proxy for the interest rate. That's why I've given you this picture here, and I'll make it easy for you. Oh, sorry. Okay. So now my question is, what is the relationship between bond prices and interest rates? So by relationship, what I mean, is it direct or is it inversely proportional, or is it direct relationship or inverse relationship? That's all I'm asking. So yes, okay, Jane 1. Can you tell me what happened? Ankit is sleeping. Okay, let's ask Muskan. Muskan, is my question clear?
Yes, sir.
Yes.
My question is, what is the relation? So, like, if I say, what is the relationship between ceteris paribus? What is the relationship between regular exercise and fitness? So you would say the relationship is directly proportional. The more you engage in regular exercise, the fitter you are likely to be. So in that sense, I'm asking, what is the relationship between the bond price here and the interest rate, which is the YTM formula here? Okay, so the YTM is actually the market interest. So in relation to this statement in the book, I wanted to also clarify this important concept and make sure that everybody is clear about it. So yes, Muskan, can you tell me what is the answer?
So
Is
it
it
has an inverse relationship to the interest
okay?
rate.
Okay, fine. Then let's see who else. If somebody else has a different view. Naman, do you have a different view from what Muskan said?
No, sir.
You also agree with her?
Yes.
Okay, fine. Now, how will we show this? Let's see if Muskan and Naman are correct. Okay. This is the interest rate. So when we talk about the relationship between bond prices and interest rates, if you ever forget this, you can work it backwards in this way. So remember this. So they're correct that it is inverse, but let's check it mathematically once again. So when we say interest rates, we mean the market interest rate. So in the bond price formula, we normally just apply the market interest rate. So if in this case, it's a 3-year bond. So, well, it's a 4-year bond, yeah, because they're added 1 year. So It's a 4-year bond. So we will look at the 4-year market interest rate for these coupon bonds. What is the YTM at the 4-year point? And we will apply the look at the actual bond. What are the coupon payments on the bond? And what's the principal redemption? And then we put it up like this. Once again, notice the basic structure of this equation is the same thing that is there in the Gordon growth model. Asset returns and a discount factor. But this is actually discount factor is 1 by this. When we write the discount, so we write it as the asset return times the discount factor. The discount factor is 1 by 1 plus A to the power 1. So anyway, so asset return into discount factor. So basically, you can see the basic structure is this structure. Okay, asset return divided multiplied by the discount factor divided by 1 plus 1 divided by that. Okay, that equation. You can see the same structure here. Okay, you can see the same structure here. Asset returns, and what kind of asset return is it? Relative to the framework that I just taught you, you can see that framework once again in action. We said that the asset return has 2 parts, net yield and price variation. So this 40 belongs to which category? To which category does it belong? The English construction.
Net yield.
Correct. Very good. So this 40 business here belongs to the net yield category. And in this term, of course, we have which category do we have here in 1040?
Price variation.
Yes.
Right.
Here, which ones do we have? Which types of returns do we have? Net yield, price variation, or both, or what? Yes. Let's ask Jasleen. Can you tell us what is contained in this? Like the earlier answer was correct. Here we have only net yield, the net yield component. In this term, what do we have?
Well, we
I
have
didn't
both.
understand.
Yeah, well, let Jasleen speak. Yeah.
Sir, I didn't. Can you repeat?
I can't hear you. Your voice is getting cut. Anyway, so sorry. So go ahead. Whoever was speaking, because we are not able to hear just clearly. Yeah, you can go ahead. Tell us what.
1040 contains both net yield also and price variation. 1000 would be the price variation and 40 would be the net yield for that 4th year.
Correct. Right. So now you're able to recognize many things. You're seeing the value of using. Hopefully, you're seeing the value of using general frameworks. You can see that the bond price, equation is the same market price of the bond. It's the same as basic structure, the same as the DGM figure, and later on we can look at NPV also. If you take out the cost of the NPV part, if you take the cost onto the left hand side, NPV is equal to C0, right? The C0 has the minus sign, and then you have all the cash flows of the project. The cash flows of the project are really like this part of it, the value of the project. And then you add a C0 here, and this LHS is NPV. So if you just take the C0 with the minus sign to the left, then that C0 is like the price of the project, and then it has the same structure as this. So it's all the same, basically. It's all the same structure. You see that? And then again, you can see the general frameworks. You can apply this in a bond investment. You can see the last component. You can see there is both net yield and the price variation. So in this way, you think these general frameworks you can apply, you can analyze all investments in all asset classes. So we saw this. Now let's look at the structure. Okay, we were trying to check whether Naman and Muskan are correct from a mathematical, using some mathematical operations or analysis. Okay, so what she said was that the relationship with the bond price here and the interest rate are inverse. Okay, so let's see if we increase, that means that she is right. They will increase the interest rate, it should reduce the bond price, and that you can see from the structure of this equation what will happen. Imagine now, for the sake of argument, that this does not have four terms. It has only one term. Okay? And the effect is the same across all the terms. So we don't need to extend the logic. So leave out the last three terms, only one term. Then what do we see here? If we increase the market interest rate, we make it 1.07, then this remains the same. So the denominator goes up, numerator remains the same. So the ratio drops, right? Which means the ratio is the price drops. So what did we see? We increase the interest rate and the price drops. Similarly, if we lower the interest rate to make it 1.02, then this is constant. Then the ratio will rise in value, and that is the price. And then you can see the price is rising when the interest rate is dropping. So the inverse relationship between bond prices and YTM as a proxy for the market interest rate. So this is something that I wanted to just highlight here. Please pay close attention to all this, because all the stuff that I'm teaching here in these notes, this you will not find in any finance textbook, okay, other than this efficient market part, because this is just my synthesis of all the material to make it easier for students to understand, so that we put everything into a general framework. So you must understand it from these notes and these discussions. So you will not be able to find it anywhere else. So make sure you understand it here as we are discussing. Okay, let that picture go down. One price versus this, we write what we discussed is the inverse relationship. Okay, we are going to show you one more way to check this. We said, remember, we said that this calculation that we are doing, this is a treasury bill return. It's a basic zero coupon investment return, which means there is no net yield component, there is only price variation. Okay, so here again, what happens is, if you see, this is actually you can use this also to understand this principle, that this is actually the market interest rate. This is a 1-year T-bill. Okay, what's happening in a 1-year T-bill. Then this is actually the market interest rate in the 1-year T-bill, because this is the market price. This is the market price is going to adjust to make sure that you get the market interest rate. So the market price is adjusted and it's giving you this interest rate. So what you can see here also is that if you can again see from here that if you increase the market price, okay, it should lower the return. Okay, so it will reduce the market interest rate. So the price will go up, but the interest rate will go down. So you can see we make this 95 and the interest rate goes down and the bond price goes up. Remember, this is the bond price. It's actually a zero coupon bond, or in this case, we call it a bill. So a bill, it's a debt instrument essentially. So this actually should be stated in prices of in general terms, because money market securities which are less than 1 year and have no coupons, we don't call them bonds. Okay? Bonds are only for coupon structures and more than 1 year initial maturity. So price, what was I going to write? I want to write it in price of a debt instrument. Now, if I write debt instrument, so you also have to understand how to use the language. Notice that also. You notice that I would written bond prices versus YTM. Okay? YTM is a proxy for the market interest rate. Okay? The interest rate that the market is demanding. So the more general term is price of debt instrument. Although if they ask you this question in the interview, nobody's going to take the trouble to be so technically correct. People in the market are not that particular. So they will just say, what's the relationship between bond prices and interest rates? So then you can understand what should be the logic. What should be logically the correct statement is prices of debt instruments and market interest rates. Because a bill is not a bond. 1 year T-bill is not a bond. Okay? Money market instruments should not be referred to as bonds. So debt instrument is a more general term, which is the correct term to use to include both money market instruments and bond market instruments. So here you can show once again that the price of the debt instrument goes up and the return goes down. So inverse relationship. Again, you bring this down, the price of the debt instrument goes down and the return goes up. So you can show it from here as well. So very basic principles. It's good to see that many of you have remembered it, but just to make sure that everybody's clear, and also be able to clearly sort of in a logical way defend your answer. Okay? How do you prove mathematically that this is true? And you can do this kind of analysis and prove that it is true. Okay. So we just leave that. Maybe we can make this picture a little smaller because we don't need that much. Yeah, that's very good actually. Yeah, much better. Always put the source. You just, I don't want to take the trouble to do all this myself. And so yeah, so this is it. That's the end of this section. I don't think I have anything to add in this. So let me just quickly go through this and say, of course, no investor can eliminate the risk of being wrong. This is very important. So you have to have that sense. Okay, so I think we have some other point. This is a very important term. Okay, please remember this in value investing. Uh, this is a very important term. Essentially, what is I think I should write a little note on this. Actually, margin of safety. So let's talk about this. Still on page 13. Let's talk about this margin of safety. It's a very important term, and many people use it. If you see investment discussions on TV, if you're watching your CNBC or NDTV Profit or whatever, you will see that many people use these terms. ET now. Uh, yeah, I think so. Those kind of discussions you'll find even in the West. You'll find on Bloomberg, etc. Discussions of margin of safety. This is a value investing term. So essentially, broadly, what it is referring to is this. This is the margin of safety concept. Let's look at its talk because let's look at this now. So if I feel now, Disney is not a good example because it's going up for so long. Let's go back to our good old example of General Electric, maybe. Yeah, that's not going too well. What's happening? Responding. Uh, okay, so some reason this is not responding. But anyway, you can see now long-term data on General Electric. Okay, so this is a better example. Now, what is margin of safety here? What we are saying is the basic idea behind market. You can see already here it talks about you can't eliminate the risk of being wrong. Now, only by a certain margin of safety. Never overpay. Okay? So essentially, you try to minimize your entry price, and more particularly, you have to look at your value investing. So what we're talking about in margin of safety is really, suppose you do some analysis and you think that the fair value of GE is maybe $400. Okay? According to you, the fair value is $400. Remember, fair value is always subjective. Okay? So based on your projections on GE's earnings, the fair value is $400, and now the current price is 104. So it's 105. Okay. So this idea here in the margin of safety is it basically roughly the excess of your estimate of fair value. That's what it's called. Okay. So we assume you enter at market. So if you buy at 105, your margin of safety is roughly around 400 minus 105. Okay. So that's the idea. So this is the idea in margin of safety. So you buy as low, and obviously if you buy, the lower you buy, the better it is for you, the more margin of safety you have. So if the price had actually now dropped to say maybe 35, 45 instead of 105, 105, it drops to 45 or something, then you can buy, then your margin of safety is even higher because it's a now increased, there is a distance between 105 and 45. So that's the idea behind margin of safety. Okay? So it's basically related to the earlier point that the higher you pay, the lower the return. So therefore, go for a high margin of safety. So you'll be familiar with this term because many people use this term in the industry. Okay. Okay, so you can see here the points about discipline and courage. I think I've told you to buy, not you don't have to buy it, maybe look for it on the internet. I think I've told you about the, this book, very important book on trading psychology. So read that. We have, okay, here. So that's fine. I think that's basically all we have to talk about here. Yeah, so what he's trying, this is also an important point, that is, it's not really a science as such. We don't normally say this about engineering or other fields where your emotional discipline and all is very important. No, it's really a matter of technical correctness. So whereas here there's much more to it than just technical correctness. Discipline is very important. Courage is also important in the sense that when the market is dropping like a stone, you need to have courage to buy. So here the price keeps on going down and everybody's bearish on GE. It takes courage to buy the stock because you're out of step with the majority of the investing public. So you feel alone, and it's not easy to do that. So that's what he's talking about. So that takes the right. So we've covered. We've spent a lot of time on this part, but we have still used it to basically we pretty much summarized many of the important ideas, and we've covered some important theoretical concepts. Okay, so let's look at the purpose of this book. I think I asked you to study security analysis also. Buy security, look for the security analysis book. Let's read what is there. Okay. So again, I will just repeat my warning. You will find very often, because I'm trying to teach you some important theoretical concepts which are needed for your, because remember, one of our goals in the MBA program is to give students, not only are we training you for the short-term goal of doing well at the interview, but also there is a goal that will be realized over the long term, which is to give you a very good theoretical foundation, a comprehensive theoretical foundation based on general principles, which you can use to analyze markets and investments throughout your career. So this basically requires a lot of theory, and you have to understand it properly. So that way we're discussing a lot of theory. So don't get turned off by it. As I said, you don't have the right to get bored. You only have the right to ask questions. Keep on asking questions until you're satisfied. So it is your responsibility to learn the concepts that I'm teaching you. Okay. So we see now. This is also very important. Okay. So please keep studying charts. Okay? Keep studying charts. Look at interest rate charts, equity price charts, and then you get to know some of the historical events, economic history as well. So this is an important point. Okay. Now, here, these guys have made a distinction which I'm not going to spend too much time on. I'll just highlight the fact that he's making the distinction. But I won't talk about the distinction too much, which is that he made the distinction that about between investors and speculators. Okay. Now I'll just briefly write it. Talking about this part, which is what this book hopes to accomplish. So this is page 15. Yeah, page 15 here. So that's why I told you study charts. Okay. So two links I gave you here. Bar chart, that's another different charting site. So you can set up, these are all free logins. I mean, you get a lot of information in the free versions. So you can log into their free chart system. And then you have Fred as well, and lots of economic data and other stuff. So you can study the charts. Now, we'll come to this investor versus, talked about, let's talk about this basically, this part. He is making that distinction. So those who are fans of this book, okay, will often talk in these terms, and you might have heard others also talk about it in these terms. And that is actually here you can see so investors versus speculators. Now, this is my view, okay? In my view, but you can understand it. Just notice here that he's making this point about investor versus speculator. But this to me is again, it's not a very. He's trying to talk about. We see what he spends a lot of time on this, okay? But my point here is that the difference that he's making here, the distinction is not very precise, okay? It's kind of a fuzzy, warm and fuzzy distinction, and it's not precise. So you have to be aware of this, but people in the market talk about this. Okay, so generally they're talking about people who are trying to make a quick buck. You can see what it is, but I just wanted to give you my observation that he makes this point. He spends a lot of time talking about the distinction, but it's long term. This is short term. Trying to make a quick buck and trying to make a quick buck here. These are all very loose statements. These are not precise. Okay, so there's a problem here, but he's going to spend a lot of time talking about it. So let's see. Financial history, yeah. So don't need to spend. You can read these stories, okay? But basically, what he's saying is that. Now, we talk about this guy, the Raskov guy, okay, who was essentially they're painting him as a speculator type, trying to make a quick buck in the market and all that. So they say that okay, whatever he said, but you could have made a better return. Actually, you could have made a better return if you had done this. Okay, and he's making a case for what is known as uh, this part here, the last part, dollar cost averaging. Regular monthly purchases of common stock. So no matter what happens to the market, every month you buy a certain amount of stock, and that's why you're averaging your dollar cost in the sense that you do this for GE, you are buying here, you're buying here, you're buying here, buying here, goes up, buying here, then going and buying and buying. So your average dollar cost is probably somewhere around here or something like that. So that's basically the idea. So now so this is what he's talking. So it's important for you to be aware of these terms. Dollar cost averaging, you know what it means. Okay? I've not written the definition here because it's on page 16. I mentioned it. Yeah. Dollar cost DCA. DCA is dollar cost averaging. Now, Remember, the Indian equivalent of that is what you have in the systematic investment plan. You might have heard this when you did your summer training with mutual fund companies. It's the same concept. Okay, so this is, if you are not being charitable, I would say that this is a way for brokerages to make money, because brokerages make money every time you buy stock, whether you're losing money or not. So whether you're losing money or not, the brokerage still makes commission income. So it's a way for brokerages to keep investors in the market. And there are certain risks associated with this, because if it never comes back, how do you know? I mean, look at this company, the big company like General Electric, and 2000, from 2001, 20 years. That's a long time. So it may not come back, right? So I just finished this topic. We finished the class. I'll just review here a minute. So understand this, that so the learning here for this point is understand what he means by dollar cost averaging. And the exact Indian term is SIP, which brokerages push very heavily. Not necessarily a very good idea. According to me, it's not a very good idea, because you're ignoring your risk is going up. You bought 100 shares here, started going down. Then you bought another 100 shares here, started going down again. You bought another 100 shares. Instead of cutting your losses on the first 100 shares quickly, you have kept on increasing your position size when the market is moving against you. Okay, so this is not a good investing approach according to me, but many people do it, and you should understand the context that brokerages use it to make sure that customers, to understand the business angle here for brokerages. As the stock market is falling, if you don't have an idea like this, your customers will not buy. So you come up with something, you use this dollar cost averaging or SIP to make sure customers keep buying even when the market is falling. And you keep making your commission income while the poor customer loses money. Okay, so anyway, so this is it. So I'm releasing everyone, and those who have to, all you guys, the class is dismissed, and those who have questions can stay back. Yeah. So I took 1 minute to get over one. Okay, anybody have any questions?
Sir, Mayank this side. I just
Yeah.
wanted to ask that, during the whole this 20 sessions, will we be covering whole of the book or some part? Because sir, I think 3 to 4 classes have passed, and 18 pages have only been covered. So
Yeah.
that's why I was asking.
No. Actually, my plan is to cover the book in sequence. Okay. But I wanted to make sure that these basic concepts, so instead of just covering the book, okay, I am also taking off on certain ideas in the book and adding certain elements from which I think you need to know, right? And which I wanted to revise also, like bond price versus interest rates. So you understand what I'm doing here, right? Certain things which I think you need to know as finance students, but which are not explicitly covered in the textbook. Are you getting my point? Right.
Yes, sir.
Yeah. So that's why. Yeah. So now yeah, go ahead.
Sir, I was asking that. So, will it be means like whole book would be covered or not?
Oh, okay. So maybe the whole book will not be covered. So what I'll do is I'll step up now, because anyway we spent most of the time on the initial summary that Jason Zwing had done. So I've covered most of the theoretical elements which we have, and now I'll try to go quickly and cover much more material in the book. Okay, but which is so we can cover as much as possible. Okay? So then I'll try to focus on that. But the reason I was doing it, so there is no, I'm not setting out with the goal that the entire book has to be covered. Okay. The more important goal is, because there's a broader goal here, which is of course to study the book, but the broader goal is that some of the basic stuff that you need to be aware of, okay, like your valuation models, there isn't a very good understanding or a summary of valuation models, which I hope I was able to give you. Okay, where you have this for fair value models, how all of them are the same. This basic theory, which is connected to what is going on in the book, but the ideas are broader in scope. And these are meant to also address the kind of jobs that you will be going for and the kind of skills you need to have there. So I have gone a little bit beyond the book, maybe quite a bit beyond the book also, because I have a broader agenda, not just what is in the book, but also to lay the foundation of of what a finance MBA needs to be aware of. Are you following? So, like this book will only be talking about value investing, which is a one type of approach. Like for instance, he's actually talking about dollar cost averaging. Now, many people don't think that this is a good idea because the risk profile keeps on increasing. And if you end up with a situation like you have in GE, which is a very big company, you can have this in any other company. So you can see straight away there are certain flaws in the book. So we are not just going to study the book, we are going to study the book from a slightly critical perspective and also a longer term perspective, because I also have to give you a broader perspective in terms of the fair value models and how you apply them and things like that. So does this make sense now? Yeah. So
Yes,
the short
yes.
answer to your question. Short answer to your question is that maybe I should have explained this perspective earlier. So most likely the entire book will not be covered. We'll see what happens, how much we can cover. But then my goal has never been to cover the syllabus as such. It's more important to cover certain important topics, and whatever we cover, we should understand thoroughly. Actually, that's the plan, right? And hopefully, if I'm able to cover some of the elements in the book, quite a few of the elements in the book, and then the rest you can do on your own. Right? Later on, you can read the book on your own. Even security analysis, you'll have to read on your own. So I will try to cover most of it, but hopefully now we can speed up because most of the fundamentals are done, right? So we now try to just go through the book, and then where there are observations like dollar cost averaging, so this I have to do, right? Instead of, you understand this, Mayank, here, like if
Yes,
I did not mention about SIP here, that would not be correct because the students need to be able to make the connection between, they need to understand that what they have seen. Many of the students did their summer stock brokerages, right? Or maybe financial planning companies. So they need to understand that this dollar cost averaging is nothing but SIP. Okay? You get my point. So that's part of the reason why I'm teaching like this, because I want, basically the broader goal is to make sure that students are taught what they need to know. That's the broader goal. And covering the textbook is a secondary goal. We are using the textbook as a kind of a tool or something like that to achieve that goal, right? Or a map or something like that.
thank you,
Is
sir.
this, yeah, is this clear? Okay. Anybody else? Any other question? Nothing. Okay, fine. So we'll see you folks. There another message in the chat. Okay. Anyway, so we are done then. I'll stop the recording and then we'll see you again next Thursday. So please remember to tell your buddies to add the names of the project groups.